So here's something that happened. Over the course of a single operation, Russian naval forces moved across 3 separate maritime zones, the Black Sea, the Baltic approaches, and Arctic shipping lanes, and detained a dozen commercial vessels. These were LNG carriers and oil tankers operated by American companies or flying Allied flags. The ships were boarded, crews were escorted, and the vessels were redirected into Russian ports. Cargo worth billions of dollars stopped moving almost overnight. There was no speech announcing it, no dramatic warning issued in advance. Just coordinated naval activity and ships that no longer continued on their routes. In Washington and in several European capitals, officials convened emergency meetings. Statements were released expressing concern. Legal teams began reviewing maritime statutes and insurance obligations. Behind closed doors, options were discussed. To many observers, this looked like a forceful move, precise, disciplined, and intentional. Not a missile launch or a sanctions announcement, but something quieter and more direct. Control exercised not through words or policy papers, but through physical presence at sea. At first glance, it seemed like another escalation in an already tense standoff. A strong action meant to signal resolve, and for a moment that is how it was widely understood. But there's a problem with that first impression. Seeing this as a sudden outburst or as an emotional reaction to recent events doesn't really hold up under closer inspection. Nothing about how this unfolded suggests haste or improvisation. The movements were coordinated across distant regions. The vessels involved were not random. The legal language used to justify the detentions had clearly been prepared in advance. That matters because it changes what this event actually represents. If this were about anger or retaliation, we would expect something louder, less controlled, and more symbolic. Instead, what we saw was measured, procedural, and deliberately framed as enforcement rather than confrontation. Crews were not declared enemies. Ships were not treated as prizes of war. Everything was handled as if it were part of an investigation. That framing wasn't incidental. It points to something more calculated. This wasn't an attempt to shock. It was an attempt to establish a precedent. And that's where the surface interpretation starts to break down. What looks like escalation may actually be something else entirely. It may be an effort to mirror practices that have already been normalized in other contexts using similar tools but under different authority. When actions are designed to resemble accepted behavior rather than defy it, the issue is no longer about outrage. It becomes a question of consequences. Once imitation replaces defiance, the conversation shifts. Not toward who is right or wrong, but toward what rules now apply and whether those rules can still be assumed to work the way they once did. So the real issue here isn't whether this was provocative or justified. The more useful question is simpler and harder to answer. What changed in the system that made this possible and made it seem plausible to those carrying it out? For a long time, global trade operated on an assumption that most people rarely had to think about. Commercial shipping was treated as neutral infrastructure. Governments might argue sanction or posture, but the movement of goods itself was largely kept outside direct confrontation. Ships moved. Contracts were honored. Risk was something insurers priced, not something navies enforced. That understanding wasn't anchored to a single law or treaty. It developed over decades through repetition and restraint. Everyone benefited from it, so everyone had an incentive to preserve it. What has shifted is not the existence of rules, but how those rules are applied. When enforcement tools are used selectively, and when economic policy begins to rely on physical intervention rather than compliance alone, the character of the system changes. Enforcement stops being a backstop and starts becoming a method. At that point, neutrality is no longer assumed. It has to be earned, defended, or negotiated. And once neutrality weakens, incentives change quickly. Governments begin to ask different questions. Companies reassess exposure. Insurers reconsider coverage. Legal departments focus less on norms and more on contingencies. From that perspective, the event itself is less important than the adjustment it reveals. This wasn't a rupture out of nowhere. It was a response to a system that had already moved quietly away from its old assumptions. The question now is not how this started, but what kind of system is emerging in its place and how durable that new arrangement will be once everyone adapts to it. To understand how this situation developed, it helps to step away from headlines and look at how systems respond when pressure is applied over time. After the invasion of Ukraine, Western governments introduced sanctions that were broader and more coordinated than anything used before. Banks were cut off from international payment systems. State assets were frozen. And most importantly for global trade, a price cap was imposed on Russian oil. On paper, this looked restrained. Oil could still be sold. Ships could still sail. The aim was not to halt supply, but to limit revenue. From a policy standpoint, it appeared careful and technical. But the effectiveness of that policy depended on something very concrete: control over the machinery that makes trade possible. Oil does not move on goodwill. It moves through ships that need insurance ports that grant access and financial channels that settle payments. If any one of those links fails, the transaction stops. Western governments didn't need to seize oil fields or blockade ports. They only needed to regulate the plumbing. As long as most global shipping insurers, payment networks, and compliance regimes were aligned, enforcement could be quiet and efficient. A ship that violated the rules wouldn't be bombed. It simply wouldn't be insured. A payment wouldn't be confiscated. It just wouldn't clear. That is a powerful form of leverage, and for a time it worked. But leverage changes behavior. It always does. Think of it like a factory that relies on a single supplier for a critical component. As long as that supplier is reliable, efficiency looks smart. But once the supplier starts setting conditions, the factory doesn't argue philosophy. It starts looking for alternatives. That's what happened here. At first, enforcement stayed at the level of paperwork and compliance, but over time it became more physical. Tankers were inspected. Ships were delayed. In some cases, they were boarded in international waters to verify cargo and pricing arrangements. Each step had a justification: environmental compliance, sanctions verification, regulatory authority. Taken individually, none of these actions seemed extraordinary. Together, they sent a message: commercial movement could be interrupted by force if economic rules were not followed. That message was heard clearly. Russia did not respond with speeches or threats. It responded the way large systems usually do when faced with persistent constraint. It started building redundancy. Exports were redirected toward buyers less tied to Western enforcement systems. That meant longer routes, more complicated logistics, and lower margins, but also less vulnerability. Investment went into Arctic shipping lanes that had previously been considered too costly or unreliable. Not because they were optimal, but because they reduced dependence on choke points controlled by others. Financial channels were developed that didn't rely on Western banks or clearing systems. Slower, less efficient, and more expensive, but functional. These adjustments didn't show up immediately in trade statistics or headlines. They showed up gradually in small shifts that were easy to dismiss as temporary workarounds. But they weren't temporary. They were structural. At the same time, Russian legal and military institutions were studying how enforcement was being justified elsewhere. Not the rhetoric, but the language. The terms used. The procedural framing. There's an important difference between saying we are exerting power and saying we are enforcing rules. One sounds aggressive. The other sounds administrative. That distinction matters because administrative actions are easier to defend, easier to repeat, and harder to respond to with force. When inspections, boardings, and detentions are framed as regulatory compliance, they lower the threshold for physical intervention. They make it look routine rather than exceptional. Once that threshold moves, it rarely moves back. From a systems perspective, this is the critical point. Enforcement stopped being a background condition and became an active instrument. And once that happens, every actor in the system recalculates. Shipping companies don't ask whether enforcement is fair. They ask whether it is predictable. Insurers don't ask whether it is legal. They ask whether it introduces unquantifiable risk. Governments don't ask whether others will accept the rules. They ask whether they can apply similar logic within their own zones of control. That's how norms shift, not through declarations, but through repetition. By the time Russia acted, the groundwork had already been laid. The idea that commercial shipping could be physically interrupted for economic reasons was no longer hypothetical. It had precedent. So when Russian authorities framed their actions as law enforcement, criminal investigations, jurisdictional claims, material witnesses, they were not inventing a new concept. They were adapting an existing one. This is how systems learn. They don't need permission. They need examples. Once the supporting infrastructure was in place, alternative routes, alternative buyers, alternative financial channels, the remaining question was timing. At that point, response was no longer a matter of capability. It was a matter of choosing when and where to demonstrate it. That's why this didn't look chaotic. It looked practiced. The ships involved were not random. The regions chosen were not symbolic. The legal framing was not improvised. This was not a reaction under pressure. It was the visible expression of adjustments that had already been made. And this is the part that is often missed in public discussion. Systems do not resist pressure by pushing back directly. They reconfigure, they absorb, they reroute. By the time a response becomes visible, the adaptation has already happened. What we are seeing now is not the start of a new tactic, but the exposure of a new equilibrium, one where enforcement, logistics, and power are more tightly linked than before. And once those links are established, they don't depend on any single decision maker. They persist because the incentives now point in that direction. That is the real structural shift. Not one seizure or 12 ships or a single confrontation at sea, but a gradual redefinition of what is considered normal in global commerce. And once normal changes, everyone else has to decide how to operate within it, whether they like it or not. The immediate effects of an event like this are easy to point to. Ships are detained, cargo is delayed, insurance premiums rise around certain waters. Those impacts show up quickly and they tend to dominate early coverage. What matters more, though, is what happens after attention moves on. Insurance markets are usually the first to adjust, and they do so quietly. Underwriters don't wait for legal clarity or diplomatic resolution. They price uncertainty as soon as it appears. Routes that once made sense on thin margins suddenly don't. Coverage becomes more restrictive. Exclusions multiply. Deductibles increase. None of this is dramatic, but all of it changes behavior. Once a route is reclassified as high risk, it rarely goes back to its previous status quickly. Even if conditions improve, the memory of disruption lingers in the pricing models. Supply chains respond in much the same way. Companies don't debate principles for long. They look at exposure and ask how to reduce it. That can mean rerouting shipments, diversifying suppliers, or carrying more inventory than they would prefer. Each adjustment adds cost, but it also reduces vulnerability. Once those investments are made, firms are reluctant to unwind them. Redundancy may be inefficient, but predictability is valuable. Over time, what began as a contingency becomes the new normal. There are also effects that are less visible but just as persistent. Crews factor into risk calculations as well. Sailors are not abstractions. They talk to one another. They compare notes. Contracts begin to include hazard clauses. Recruitment becomes harder in certain regions. Turnover rises. None of this requires repeated incidents. The expectation alone is enough to shift decisions. That's an important point. Modern power doesn't rely on constant enforcement. It relies on shaping assumptions about what might happen. Once those assumptions change, behavior follows automatically. The result is inertia. Systems adapt in one direction and then resist moving back. Routes stay altered. Insurance remains cautious. Legal departments remain conservative. The system doesn't snap back when a crisis fades. It settles into a new equilibrium. This is why the long-term consequences of events like this are so difficult to reverse. No single authority controls all the adjustments. They're made independently by insurers, shipping firms, ports, and crews, each responding to their own incentives. From the outside, it can look like nothing much has changed. Goods still move, markets still function. But beneath the surface, the cost of doing business rises, flexibility declines, and resilience is bought through redundancy rather than trust. Those changes don't announce themselves. They accumulate. And once accumulated, they become the background conditions that everyone else has to plan around. This isn't an isolated episode. The logic behind it has appeared before in different sectors under different labels. We've seen it most clearly in finance. Asset freezes were once treated as extraordinary measures used sparingly and framed as temporary. Over time, they became routine tools of statecraft. What began as an exception turned into a standard response. Other governments took note, built their own mechanisms, and began using similar tools within their reach. The result wasn't financial isolation for one actor, but a gradual fragmentation of the financial system itself. The same pattern is played out in technology. Export controls on advanced components were initially narrow and targeted. They were justified as safeguards, not as long-term industrial policy. But once those controls proved effective, they expanded. Entire supply chains reorganized. Companies redesigned products to avoid dependencies. New production ecosystems emerged outside the original framework. Years later, the headlines had moved on, but the industry had permanently changed shape. Energy offers another example. Decisions about pipelines, terminals, and shipping routes are often presented as commercial or technical choices. In reality, they lock in leverage for decades. When access becomes conditional, alternatives are built. Those alternatives are rarely dismantled, even if the original conditions soften. Infrastructure once duplicated stays duplicated. In each case, the visible action draws attention. Sanctions are announced. Controls are imposed. Assets are frozen. But the lasting impact comes from what others learn. Tools that work don't remain exclusive. They invite imitation. Other states study how authority is exercised, how rules are framed, and how enforcement is justified. They adapt those methods to their own geography, legal systems, and capabilities. This is where assumptions matter. Believing that only one side can enforce rules is not a strategy. It's a temporary condition dependent on imbalance. Once reciprocity appears, once multiple actors can apply similar pressure, the system shifts, not abruptly, but steadily. And systems that shift in this way rarely return to their earlier state. They don't collapse. They reorganize. What follows is not chaos, but complexity. More checkpoints, more contingencies, more planning to account for actions that used to be unthinkable. That pattern is familiar. The current case fits it closely. This leads to a conclusion that is uncomfortable precisely because it is so ordinary. Power in practice does not belong to the actor that announces decisions or moves first. It belongs to the system that continues to function when assumptions begin to fail. When rules become contested, when norms erode, and when enforcement is no longer one-sided, influence shifts toward whoever can absorb disruption and keep operating. The specific seizures matter less than what they reveal. Commercial neutrality was never guaranteed by law alone. It existed because most actors chose to preserve it. It was sustained by restraint, predictability, and the shared belief that some parts of the system were better left untouched. Once that belief weakens, behavior changes without anyone needing to declare it. Enforcement becomes reciprocal. Risk becomes embedded rather than exceptional. What once felt stable starts to feel conditional. At that point, the system doesn't collapse. It adjusts. Quietly. Insurance models change. Routes are reconsidered. Legal language evolves. None of this is dramatic, and none of it is easily reversed. The result is a world that still functions, but with more friction and less trust built into its foundations. Not because someone intended that outcome, but because precedent replaced restraint. That is often how power actually works. Not through decisive moments, but through accumulated adjustments that only become visible after they have already settled into place. And once they do, the silence that follows is not reassurance. It is the sound of a system moving on,